Hi, so in the previous video we looked at a distortionary tax in labour income taxes, and now we're going to look at another distortionary tax, which is capital gains tax. So this is just a tax on our earnings from investments, or more accurately, the earnings that a firm gets from its investment. And so this will affect how we optimally invest in investment in our model, because we are effectively changing the price, or we're changing the returns from investment. We're changing returns. So in a previous video, we derived a result that our marginal product of capital was going to be equal to the depreciation rate and the interest rate. But now we are going to be adding in a distortionary tax where our product or our profit from capital is being taxed at some rate which we'll call tau. So this condition is no longer what we're interested in. We want to generalize this such that we have some sort of tax rate involved. So the way we're going to generalize this is that our optimal investment is going to satisfy this equation where that shouldn't be a plus there. We are going to multiply our marginal product of capital by this 1 minus tau term, because our profits from capital are going to be taxed. But it's not just the marginal product of capital that we're taxing. We are going to multiply it by our productivity in period 2, and we are here talking about marginal productivity of capital in period 2 because if you look back to our investment video, we invest in period 1 to gain capital stock in period 2 because we have time to build. So watch that video to understand that a bit better. And we're going to subtract depreciation on this side and set this equal to R. And why have we done this? Well, that's because this term here is the thing that's being taxed. This is our earnings on our investment. It's our marginal productivity, and we have this productivity term in A2, not our marginal productivity, our marginal product of capital multiplied by our productivity term. If we increase productivity, we're obviously going to increase our marginal product of capital. And we also take away the depreciation here, because we are going to say that our depreciation is tax deductible. So we can take away depreciation before we are taxed. So that is included in this term, and it offers us a tax deduction. So the more depreciation we have, the less we have to pay in tax. So a couple of things we need to note is that we have diminishing marginal returns to capital, as we often assume in pretty much every model we do. So our marginal product of capital is decreasing in investment, decreasing in I. So as we increase investment, we're going to be decreasing our MPK2. And what this implies is that if we increase our tau, our tax rate, we are going to have lower investment. And this makes a bit of intuitive sense on its own without using our assumption, because if we increase our tax rate that we get on our returns from investment, we are going to expect that we are going to decrease the amount of investment that we have. But okay, let's have a look at the distortionary effect on an economy that this capital gains tax has. And when we're thinking about the economy here, we're going to look at our goods market equilibrium. So we're going to draw a diagram, but first let's think what goods market equilibrium means. It means our goods market clears, so we have our overall supply is equal to our overall demand, or our aggregate supply is equal to aggregate demand. And we have seen from previous videos that our aggregate supply is dependent on the interest rate and on our productivity parameter in period 2. I won't derive this result, it's in our goods market equilibrium video. And now this supply is also going to depend on our capital gains tax rate tau. If we increase our tau, we are going to be decreasing our investment, and so this is going to affect indirectly on our supply. And so this supply has to equal to our aggregate demand, which we split into our consumption and investment. We're not going to worry about government spending in this model right now because we're not changing anything there, so it doesn't really factor into this video. So we have consumption as a component, and we know that depends on the interest rate and the present value of income in the neoclassical model. And we are going to add investment, which is the thing that we actually care about in this video, because we're going to change something that it depends on. And we know that investment depends on the interest rate, the parameter A2, and it also now depends on our capital gains tax. We've just said if we increase the capital gains tax, we're going to decrease investment. So we can take note that this is going to depend negatively, and of course we know we've seen what all the other relationships of everything else is in this model, so I'm not going to go over how say consumption depends on present value income. We know that that depends positively, but okay, and what this means is that our aggregate supply is going to depend negatively on our capital gains tax rate, because these two are equal. So, but we will derive that, or we'll find that result by first drawing our diagram. So let's do that. Let's get some axes. We are looking at goods market equilibrium, so we need some axes of the interest rate against our output on the x-axis. So let's get a pen and say we have R1 and we have Y1, and we are going to have an aggregate demand curve as always, and we're looking at period 1 here, so we'll subscript all of these by the period 1. And okay, we initially start at some equilibrium output level Y1 star and R1 star. Very nice. So we have our conditions for goods market equilibrium above. If I just scroll down a bit, and we have our initial equilibrium. So what are we going to do? We are going to increase our capital gains tax rate and see what happens to good market equilibrium. So nothing changes directly from this. We don't have an immediate impact like we did with a productivity change. We don't immediately just have an instantaneous change in our productivity of our outputs or anything like that. So nothing changes directly. But indirectly, something does change by the fact that we have higher capital gains tax. And this comes through a condition we noted earlier, all the way up here. It is the top equation we drew, which said that we have this sort of a relationship. And what we have when we increase our capital gains tax, we are effectively decreasing the marginal productivity of capital in our economy, because our returns are being taxed away at some rate tau. And so as we increase the amount that's being taxed away, our marginal productivity of capital decreases. And if we decrease our marginal productivity of capital, we are going to decrease the marginal productivity of labour, because each unit of labour working together with capital is going to be less productive, and so we are producing less with the same units of production, or we're producing less by way of profits anyway. So the firm is going to cut back on its labour, and so we have a reduction in labour supply. We have a reduction in supply in the economy overall. So we have this shift, and this comes from a reduction in labour supply, and so we have a reduction in output supply. So that is our indirect effect to start us off, but now we have a bit of a knock-on effect coming from this. And why do we have a knock-on effect? Well, we've reduced our labour supply. What does this mean? People are going to have lower incomes, lower present value incomes. People are being laid off, they are earning less, so they have lower present value income. Now, in this economy, we don't have this unemployment idea, so people aren't really being laid off, they're just not being allowed to work as much as they previously were, because we only have one representative individual that we're micro-founding from. So we're just going to say that there's fewer hours worked. In reality, we would probably observe this as just some people are being made unemployed, but here we'll just say that people are being allowed to work fewer hours, so they have lower incomes. This lower present value income obviously enters into our consumption function here. So we have a shift to the left of aggregate demand to this new curve here. Okay, that is our second indirect effect, and we actually have a further indirect effect where we have, as we can see, our capital gains tax is entering directly into this investment function. As we have lower returns from investments, we are going to decide to invest less in our economy because we are gaining fewer earnings from our investments because a big chunk of that is being taken away as capital gains tax, and investment enters into our aggregate demand function. So again, we are going to shift our aggregate demand to the left yet again. So a very sharp decrease in aggregate demand coming from decreases in consumption and a decrease in our investment. So that is all the effects we have here, and we're going to have this overall effect where we have the interest rate falling and we have the output falling by quite a substantial amount due to capital gains tax. And so this is quite a negative and bleak picture we have from capital gains tax. The neoclassical model doesn't really like this. It usually would point us towards giving out investment subsidies, because investment has multiple impacts on marginal productivity and on future output. It comes into our aggregate demand today, but it also increases our capital stock tomorrow. So we tend to like to have investment, and capital gains tax are not usually the way to go. But our overall effect here from our capital gains tax is that we clearly have a reduction in output, we have a reduction in the interest rate, and we can actually say something about our components of aggregate demand. If we were drawing them on this curve, we would say that clearly investment has fallen, but we are uncertain about our change in consumption, because we did have a fall in consumption due to present value income, but we've also had a reduction in the interest rate, so we're a bit uncertain about our consumption. However, long run consumption will fall, so we have a reduction in C1, and these are kind of the period 1 parameters. Our long run consumption is going to fall because we have lower investment, and so our long run output is going to fall due to this capital gains tax. So not necessarily a great thing according to this model, and I think you can say in general we don't really like capital gains taxes, or I don't really. Investment is a good thing in general. So that is going to wrap up this video. Make sure to check out the playlist if you have missed any of the previous videos, and that will help your understanding in this one. This is probably going to be the end of this series on intertemporal macroeconomics, so no future videos for now. Subscribe for future economics videos, and drop a like on this video if it was at all useful.